waking up, fire in the soul, shots on the screen, taking full control. London session calling, the volume is high, watching the candles, reaching for the sky.
Strategy locked, no room for doubt. I know what the movement is all about. From the one-step plan to the two-step challenge, finding that edge, keeping the balance, no distractions, phone or silent mode, deciphering the market, cracking the code, precision entry, the setup is clean, living the life inside the machine.
Patterns forming, packets called, balance base slow down, standing strong through it all. Risk defined, profit inside, Seacrest Markets guiding every step into the light. Seacrest Markets leading the way. Making a move every single day. Charts in the vision, strategies align with every trade. Our future is defined. Charts in the vision, strategies align with every trade. Our future is defined.
Let's talk execution, let's talk speed. Damn, the crystal clarity is what we need. Some is action, just the prices I see it. If you dream of the top, then you gotta be it. Spreads are tight, the conditions are prime. Scaling up the ladder, one trade at a time. Global access, yeah, we worldwide. We're the brokerage back firm, right by your side. It's not a gamble, it's a calculated risk. Reviewing the data, checking the list. Green on the screen, yeah, the feeling is grand. The power of the market in the palm of your hand.
Master of the pulse, heart rate steady. When the window opens, I'm already ready. No revenge trading, no chasing the rat. Following the logic, the plan in my head. The market is a mirror, it shows who you are. Trading like a pro, reaching for a star. Seacrest is the vessel, the compass is true. Breaking every barrier, breaking on through. Discipline and patience, the tools of the trade. This is how a lasting legacy is made.
Chasing the sun from the east to the west. Put the strategy through the ultimate test. Sydney is waking while New York is sleeping. Watching the levels, the promise is keeping. Laptop open by the ocean shore. Every pip gain is an open door. No 9 to 5, no shackles, no change. Just the cold hard facts and the capital gains. From the rooftop bars to the quiet floor. Seacrest Markets gives you so much more.
Patterns forming, markets call, balance base drawdown, standing strong through it all. Seacrest Markets leading the way, making the move every single day. Charts in the vision, strategies align.
Welcome everybody. Apologies, had some technical difficulties this morning, so I was just fixing through those. But team's pretty stretched at the moment because obviously what's going on. So we are I was unable to update you during that time. Give me one moment because I can see that the chart still hasn't loaded on the screen. It has now, so that is superb. Okay, good morning, Wiz. How you doing? Hope you're well. Hope your trading's still safe. It's been a busy week. Yeah, I can imagine. It's been a very busy week. Anthony, good morning. Casual hump day today is Wednesday. Putting the hat on rather than kind of slick backing the hair. It's not good for the health just to continuously gel your hair all the time or put product in your hair. So hope this is acceptable for you all. Market-wise was pretty quiet yesterday. I know that we had some good moves across some crosses. So if you look at sterling yen Anthony, I don't know if you were looking at sterling yen yesterday, but huge move to the downside. But overall markets were pretty interesting, to say the least. I think, sometimes we do need a market that's going to range out. I think markets are traditionally now looking to deluge the data. There was quite a lot of disruption recently. Critical economic reports are kind of continuing to come out this week, which we're hitting the tape. Again, to touch upon the US government shutdown, we had a tug of war between rotation out of risk assets into hard metals. Then we saw a huge rotation out of hard metals. And then we saw the tech sector grappling with the SaaS apocalypse and massive AI infrastructure costs. So whilst I continue to reiterate these sort of rhetorics and overall breakdowns of the way the markets are, it's important to understand how the market is functioning and why it could be functioning that way. From a data perspective, we're expecting that flood now. We've got Fed friction. We've got the cleanup from the shutdown. We have, obviously, the main event will be non-farm payrolls. We've got continued talks from the Fed with Beth Hammock, which struck a cautiously optimistic tone yesterday, which what that does is it suggests that there's no immediate urgency to rate cuts. Now, what that will do is keep the US dollar supported. Leading on to that, we've got fatigue in the indices. We have recently, seen the indices hit records. We've got fatigue in tech. Like I said, we have the SaaS apocalypse. We've got the Dow. We've got the Europe indexes like the DAX, the Stock 600. And they're all trading near their record territories. So we will see a stall as investors await global data. Now, again, being the FTSE, being the DAX, they have massive exposure to the US. So they're waiting for US employment data. That will potentially be the rodeo. That will kick off the show. We did see that rally contain around that 6,980 level, which we were talking about during yesterday's session. And the market overall was pretty range bound. Okay, you could have probably taken a trade or two on the lower time frames, but there was no major swing moves that we could have taken advantage of. There's a lot of positioning currently going on. There's battles between sellers and buyers trading up around this kind of big round psychological number. Had some home arrangements and renovations to do. Yeah, nice. I mean, markets have been busy. Employees at Seacrest have been busy. And life outside the markets is pretty, because of what's going on internally within SM and the closure of the prop firm, transitioning to the fully fledged broker and really kind of supporting all of the clients on the prop side on the wind down of that arm. Personal life has pretty much had to pause, which is a pretty sad time, if I'm honest. The internal pressure to process all of the incoming requests and pencil pushers, delegating and all of this jazz. It's quite a beautiful storm is the right word, because it's chaotic, but it's managed properly and it's beautiful. At times, parts of the storm cause issues, as they always do. Nothing is ever esoteric, utopian, vanilla. Might seem it from the outside, but it is a beautiful storm. That's the best way to describe it. It's a good word. I like that. So, all right, comments, questions. Fire the comments and questions at me, because I can talk about the markets all day long, but let's have some two-way communication. Let's have some rhetoric where we can actually identify issues, potentially consider looking at how gold is trying to, reclaim the $5,000 psychological level. It's what's the situation? Are we finding support at those levels? is the 10-year treasury going to continue to trade around 4 1/5? Are we going to see silver follow the historic crush and attempt to build a base around $80? Are we going to see any further increased CME margin requirements? Obviously, it's 15% right now. Have we purged most of the aggressive speculators? So there's a lot we could discuss. And I can sit here and break down the S&P, metals, Bitcoin, the DXY, and any instrument that you do so wish me to do so throughout these daily calls. We can discuss why Bitcoin is continuously under pressure, trading at around 68,000. Yes, it's nearly lost 21% of its value year to date. And we do potentially deem it as officially, from a technical standpoint, a bear market relative to that peak that we experienced in October at 126,000. Where's the sentiment at? So are we seeing some form of Trump trade premium, which maybe has completely evaporated? Is cryptocurrency and Bitcoin now being treated strictly as a higher beta risk asset rather than a digital gold hedge? Question: how do you incorporate fundamentals with technicals? So on a day trading basis, you're not really incorporating your fundamentals into it as such. You're understanding what's happening in the macro, geopolitically, what news is coming out. And then if you're trying to position yourself from an intraday perspective, if you're not scalping, okay, so that's a different caveat. If you're only trading intraday, unless you're trading with the news, i.e. you're utilizing the news for your edge, when you're day trading, you're more so incorporating the fundamentals to understand when to trade, what data could be the big drivers for that day or for that week or for this month if you're looking out that far. And then you're also trying to identify, how do I position myself on a daily basis in and around that news? So if, for example, we've got non-farm payrolls and data coming out this week, usually and traditionally from Wednesday, which is today, a day to 2 days prior non-farm payrolls, you will traditionally see the market slow down. There will still be volumes trading into it, but the overall volume will be thinner. There will be lesser volatility because people aren't trying to push the market around. A lot of people will be waiting for that big data release. So if they haven't already traded this week and positioned themselves and they're day trading, most likely, or more often than not, what we tend to see is those that are more informed in terms of speculators, they will soften out their trades and they'll sit on their hands up until the data is released. Now, how they will then incorporate the fundamental data if the news has come out. Let's just say the non-farm payrolls has come out right now and we see a move in the markets. The beauty of the way many people trade, or the way, more so me, the way I trade, is I'll never trade the news. I'll fade the news. So what we want to be looking at is, what is that data printed? So for example, non-farm payrolls. How is non-farm payrolls printed? Is it in line, above or below the analyst expectations and guidance? What is the tone of comments? So are there any, are there any supporting comments to the data, i.e. are we seeing some dovish or hawkish comments from the Fed, if there are any supporting comments from the Fed, and how is the market reacting? Once we've understood all of that, we can start to look at the news as, okay, the worst has now come out. We now need to put an idea or look for the market to base and position ourselves in line with that. So many times before, what we would have seen, and I'll just start drawing this, is, we'll get range bound PA coming into non-farm payroll, and let's just say we've got a big spike to the downside on non-farm payrolls release. From there, traders will do a couple of things, and we've seen it. Traders will chase this move all the way down, and you'll get many people trying to sell this leg. Now, because during that data release, the volume will be very thin, spreads will widen naturally because there is no liquidity. So that means your spread will be your spread will be wider, meaning your entries will be slipped more often than not. Or you won't get filled, again, depending on the type of order you're using in the market. So once this data's come out, we'll start to get, or maybe some moves to the downside, continuing with that and really positions. But then we start to see maybe market trading back up, this is what we would call fading the news, right? So we are now fading the data that's come out, because what we've seen is we've seen a knee-jerk reaction to the data because they appear to be negative. But when you actually take into full understanding the context of what's happening in the market, now that the bad news has come out, we've really potentially hit that bottom, right? So this is where your intuition will come in as a trader. It's very difficult initially to understand this, but when we're fading that news, we are fading the fact that the fact has now come out. All of the initial sell-off was based on the initial rumor and data coming out and that knee-jerk reaction. But now people are starting to digest that data. And in this scenario, it isn't as bad as it seems. So people will now be stepping back into the market once their methodology starts to really come to the fore and actually the market shows its hands. That's when traders will start to actually get involved, and that's where fading the news comes into play. It doesn't necessarily mean that the market is going to continue higher, and it won't necessarily continue higher in a straight line. But what it does give us is the ability to look for that momentum to fade that initial announcement and maybe exploit some of that positioning. It could just be a pullback into some form of area, be it a resistance, be it a supply. It could be looking just to find the next set of resting orders based on liquidity to continue its sell-off. Or like I said, it could actually be the move to continue trading higher, depending on the overall momentum, the overall rhetoric, the overall theme, the overall trend, etc. So from here, let's say we faded this. I don't know. Let's say we got involved. Let's say we got involved here, right? We're fading this. We've made our RR. We're happy. We're done. We're out of the trade. So our RR comes off the board, right? We've hit our trade. We're out. What happens next, to some logic and to some degree, doesn't matter. We might then see market actually continue to sell off because we've had that initial sell-off. We've retested some specific levels, or we've came into deeper volume that was sitting in the market at another level after that sell-off. And what they would have been doing is waiting for the news to come out. They would have then entered via resting some form of order, and then they would have had their liquidity resting inside those levels. And then that would have continued the sell-off to the downside. And that could be because that initial sell-off was exhausted. Markets were overextended. Now we're looking for something higher in terms of premium to get short to continue to the sell-off. And it can happen in both ways. So if I invert the chart, for example, we had a range-bound market at the bottom of the trend. Data is then released, bullish data, but then we start to get the fade in the news. So we could look for shorts in that fade. Again, similar scenario, doesn't necessarily mean it's going to continue to the downside and break that previous level, which would be the area of demand, the range. I was going to look at pricing, but it would be about 6,600 or something like that. But obviously where I've inverted the chart, it still shows as it still shows as inverted. It could mean that the market's looking to base back into discount or into equilibrium and then continue higher. So you're fading the news, which is much more probabilistic than trying to trade the news. So on an intraday basis, that's how we would realistically combine fundamentals with our technicals. First of all, we're identifying when the fundamental data is coming out. Do we need to, is it high impact? Is it medium impact? Is it low impact? Is it red, orange, or yellow news? Again, depending on the data is dependent upon the provider of the site as well. So that's quite subjective. So for those of you that use TradingView, if you're using the economic calendar from TradingView, that calendar is an RSI feed from Trading Economics. Now, Trading Economics is probably one of the best retail economic sites out there for an everyday trader that is looking for specifics. You know, yes, you've got MyFX Book, FX Street, and all of the above. But what you will find, I think even Forex Factory as well, and I can't remember if that's still active, but Forex Factory, MyFX Book, FX Street, they may have high impact news on one website, but then another company or another news feed and website has rated it as medium impact. So from there, you will need to make an informed decision. If you're checking both, you will need to make an informed decision as to which data you're going to look at. Realistically, you're going to focus on the high impact data because that's the worst case scenario and that protects your powder. But you don't want to be put in a position where you're second guessing the data that's coming out, because simultaneously and on a completely different scale, 1 week you might have FX Street putting a particular data set out as high risk versus MyFX Book. And then the following week, MyFX Book may have another piece of data listed as high impact red folder, whereas FX Street may have that data as orange folder and medium impact. So now you're second guessing yourself all the time. So you need to find something that's consistent, and you need to find something that's pretty much the source or close to the source of the truth. In my opinion, Trading Economics does that. Now, Trading Economics, like I said, is the economic feed for TradingView from memory. May have changed, but when I last had that conversation with someone from TV, the economic calendar was Trading Economics. Trading Economics, hands down, is the go-to for me. Now, to answer the second part of the question, if you're a scalper, we can talk about that in a minute. But if you're a position trader or a swing trader, the likelihood is you're going to be exposed to the fundamentals, whether that be the macro, the geopolitical, or the micro. So macro or micro. Micro is obviously corporate related. So corporate governance, revenues, earnings, etc., etc., etc. Now, those are obviously depending on the index you're trading. So, for example, the US, you'll have your earnings quarters, your earnings releases, like we've recently gone through and are continuing to do so. And those earnings will be obviously particularly concentrated not only to the stock, but to their sector. Again, if they're weighted very heavily, like Microsoft, if they miss by 1 or 2%, there's initially that move in Microsoft that will happen, but there could be some leak and bleeding into other companies that are, one, in the same sector as Microsoft, so the same tech sector, or two, exposed to Microsoft through some way, shape, or form. So you'll get that kind of linearage or that leakage out of a particular stock from a micro perspective. But the majority of the time, it's concentrated to the company. Now, again, the caveat being, depending on what I'm referring to there, it could leak out into other companies because investors could be spooked by the fact that there's commentary in Microsoft earnings that suggests that the market's slowing down. The demand for chips is slowing down. You know, things like that would send an echo throughout the market. majority of, if it's corporate governance related, like let's say Nike, like a dollar NKE, the ticker value for Nike, last year their stock was, still is to be fair, but the stock was doing awful. And when you really look at Nike, what have they done that's innovative to the world lately in the last couple of years? The question you have to ask yourself as a swing position investor is, do you believe Nike will do something revolutionary that their revenue next quarter will increase? Do we expect next quarter revenue to be higher? I.e., will that allow us to trade the stock and drive prices higher? If you don't think that, then and your fundamentals and your technical overlays actually back that up, or don't really provide you with a promising story, and it's kind of a situation of, well, we need to wait for that momentum to kick in. If you don't see it as a value investment as well, then you're just waiting. What do they need to do to make their company great again? And what Nike aimed to do was replace their CEO. So they replaced their CEO in the hopes that the CEO would provide new guidance, would be able to provide new growth. And that doesn't necessarily always happen, because there could be certain things internally. Nike could be running out of investment or margin. Their margins are thinner, their investment's thinner, so they're not having enough money to promote their brands. Just a general example, right? It's not the right example. And what then happens is the CEO is almost constrained in creativity because they don't have the resources to expand their brand. Or the CEO doesn't necessarily have the belief in the market or belief from the market that he or she can go on to push that company to new growth. Now, the CEO they brought in actually does have a very good career history. So he does bring with it experience. He does bring with it resounding support. So sometimes you need to see a change at the top to bring in and drive new ideas, drive new revenue, drive new this, drive new that. But it isn't always because of, for example, the CEO as to why that would happen. Same with PayPal. PayPal to me is a stock that I don't understand why anyone would hold it, why anyone would look to buy it right now. There's nothing innovative about it. There's nothing, regenerational. That's on a micro basis, right? So micro is your corporate earnings, your corporate reports and releases, revenues, etc. And then obviously your governance and bits like that. You'd have seen it in BA as well, most recently. And then on your macro is, again, it's never forward looking. It's always looking back, right? And when people are setting out monetary policy expansion or they're setting out new policies, they're not looking about what's going to happen short term. They're looking about the next 6, 12 months at the very minimum. So when we look at macro from an investment standpoint, traditionally, we don't let that get in the way of our overall investment thesis. So, for example, I know Nvidia took a hit yesterday, but for example, Nvidia, unless an economy brings out specific macro policy on imports, exports, let's say imports, exports, let's just keep it like that. If like Donald Trump did with Nvidia last year and chips, Nvidia with the import export stuff in China, the restriction of certain chips to be sold to China was cut off. So they weren't able to do so, which meant Nvidia potentially was exposed to less sales. Now, in the realism, it didn't actually happen. We saw huge sales continue at Nvidia. We see decent Q-on-Q growth. When you start to look at the numbers, actually, the majority of chips weren't being sold to China anyway. They were being sold elsewhere. And there are always ways to get around it and bypass it. For example, certain hubs will be set up overseas, and those countries will then buy those chips from Nvidia. But these companies are basically just a shell company that are in, purchasing these chips on behalf of companies in China, which then they ship across to China. So there is always a way indirectly to get around that until further policy is brought in. So they're the macro, again, interest rates, spending. We look at all of it. But the majority of the time, we need to identify, okay, what specific policy, like non-farm payrolls, data like that, generally speaking, it doesn't affect a specific stock. It will affect the market, but based on, the way the stock markets move and the constituents, it won't necessarily be concentrated to specific stocks. It will be open market. So that's how we would factor it in on a fundamental basis with stocks. But predominantly, when I'm analyzing stocks from my investment portfolio in the evenings, usually I do it end of market, close of market, before the new day. I'll be looking at overall micros. So fundamentally, so first of all, comes up on my screener, tells me all about the stocks that I'm looking at, or the stocks that are within my range based on my screener tactics and my screener techniques. So when it comes on my screener, let's say I have 10 stocks. I will then go through all of those 10 stocks subjectively. So if it's like an ADR, for example, I'll get rid of that straight away. But I'll look at all the 10 stocks. So let's say there was 2 ADRs. I'll look at 8 stocks. I'll go through all 8 stocks. I'll look at the different metrics that I have. I'll look at all of the micros that they've provided me with. And then I'll go in and look at, like, for example, their balance sheets. I'll go and look at their earnings per shares. I'll go and look at their PE ratios. I'll go and look at their volumes. I'll go and look at their float. And then once I've done all of that, I'll go into the charts and then I'll look at it technically. Traditionally, I'll do that simultaneously. So I'll pull the chart up on the ticker whilst I'm doing the micro, so I can already get a sense of what's actually going on in the markets. Then from there, I whittle it down, or of these 8 trades, none are worth investing into. So just move on, nothing done. Next day, similar scenario. I get 20 stocks, 5 of them are ADRs. I've got 15 left. I'll then look at those 15. Oh, there's one idea here that's screaming out. I don't necessarily go through. There are some people out there, there's big portfolio managers and big investors. And one of the guys I used to work for, he would go through the entire index every evening, tick, tick, tick. And traditionally it'll be on the weekly. So I'll go tick, 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 and just look technically. And then from there, he'd build out the fundamentals from the back of it on the micros. I go the opposite way. I screen everything. So I don't have to go through 300 stocks. In the early days, I used to go through 500 to 1,000 stocks a day, but then I wasn't necessarily day trading as much as I have done in the last 8 to 12 years, I'd say. More so in the last 8 to 12 years, I've been specifically day trading, whereas in my old positions, you're not necessarily allowed to day trade as much unless you get clearance from compliance. So you are doing it lesser. And if you were trying to trade less than 30 days, then you'd obviously need a good reason to do so. The majority of the time, you weren't allowed to hold a position for less than 30 days. So it caused fragments. And then even from that perspective, there were further fragments, which was, I need this cleared. And by the time your compliance team would come back to you with the green light, the position had potentially already started moving. So you're like, oh, well, I don't want to get involved in this now because the entry's gone. It's moved up $1 from where I wanted to get on, because I told you about this a week ago and it's now a week later. Anyway, so I don't scan all of the market. I now use technology to scan the market for me. And that's been the case for many, many years. It doesn't necessarily, I'm not talking about all of this new AI stuff. I haven't actually implemented that into my investment portfolio as a thesis right now. I'm using traditional screeners, which I pay for every year. And those screeners will allow me to customize the subset of data that I want. And then from there, it will send me an email every single day. It'll also provide me a notification in the web-based channel that I've got. So from there, that's how I combine it on. But on a day trading basis, that's where realistically you're more focusing on. But I like to provide the full scale. And then on a scalping basis, fundamentals, again, most of you that scalp will also be looking to scalp the news. So if I was going to scalp the news, if it was me, I'd be looking at acquiring Squawk. So Squawk is your on the money news announcement. It's probably the quickest RSS feed you'll ever get. You'll get something come over the tannoy. It's like Bloomberg but quicker, you know. So your RSI news squawk will just be sitting in the background. You pay $200, $300 a month for it, for example, and it will just shout out all the news. Bosh, 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 bosh. And as a scalper, you want to be the quickest in the market. So how do you do that? You get closer to the servers that you're executing on. You run a VPS. You have Squawk. You have the fastest internet connection that you can. And you don't necessarily run your internet over Wi-Fi. You run it from hardwire because you get that consistent connection. And that is, you know, they're the three first things that you do if you're scalping. And then you move into the lower timeframes, right? So when you're scalping on lower timeframes, you're looking at the news releases. Once you've got your foundations and fundamental base put in, when we're scalping on your whatever, I don't know what you scalp on, your seconds timeframes or your minutes timeframes, when that news comes out, you are one of the most informed you could be. You know, you've got your volume books, you've got your Squawk data, you've got your VPSs, you've got your hardwired internet connection. And from there, when that news data comes out, you're just literally trading the initial announcement. Because most of you that scalp are scalping either the spread, or you're scalping a few ticks or a few pips or a few points, whatever you're trying to scalp specifically and dependent on what instrument you're trading. So you are more towards the frame of fusing that analysis together, because you're trading not necessarily technicals, but you're obviously utilizing some form of price action. You might even just be going out to Heikin-Ashi. You might even be just using pure line charts, but majority of the time, most of you will be using your Japanese candlesticks. And maybe you'll be scalping based on price action, which is, I don't know, you got the news release on the first 10 seconds of the candle, and it's obviously a big engulfing Marabuso candle. It could be bullish, it could be bearish. And then you're waiting for that new candle to show up, and then you're going to hit it because you know the news is bearish. The opening candle of that news was bearish, and you've got at least maybe 10 seconds to 1 minute to kind of take full opportunistic goals or exploit that move, right? So there's so many different ways to compare your fundamentals to your technicals depending on the method you're trading, being scalping, being intraday, being swing position, or investing. So hopefully that answers your question, Wiz. I know it's a long-winded one, but as you know, I'm not really the type of person that's going to glaze over an answer. I'm not just going to say, oh, well, you do fundamentals and you do technicals and this is what you do. I'm going to give you the full breakdown to make sure that it covers every facet, unless you give me a better question. And a better question would be, how do you incorporate fundamentals with technicals, specifically for day trading, specifically for scalping, specifically for this? But whoever's obviously on this stream, hopefully they've taken some value from each quadrant that I've just discussed. So let's go back into the markets, because obviously I've got no further questions at this moment in time. Let me just get rid of this because the chart's now been taken back. So during yesterday, again, 4 hour, we'll look at the 4 hour, but all we're getting at this moment on the 4 hours is those particular rejections from that higher time frame supply. That 7,000 range is still being defended. Obviously demand is still in control, right? You know, we've got this rejection from this particular point of demand. Hasn't been the best rejection. You can see we've just started to round off. It almost looks like a H. So we've got the move down, reaction, and we're starting to round off. Again, lower time frames obviously give us the picture because it is fractal. We can see specific lower time frame front leg kind of markets develop out throughout. No break. We've then swept obviously the subsequent break. We've come back and we've respected supply. So higher time frame and mid time frame demand is in control. Lower time frame, we're starting to show signs that supply is trying to take us in control. Now, could it be one of two reasons? Is supply taking control to push prices even lower? Or two, is supply taking control to bring us back into demand so that we can continue with the higher time frame momentum to trade higher? Now, factor in the further consideration that we've already broke that previous low and we're bearish unconfirmed even though demand is in control on that front leg, there are a couple of different scenarios. Again, psychologically, we're trading at that big round number of 7,000. The level's being defended continuously at this moment in time. Is there enough volume on the sell side to take out buyers and trade lower? Are we experiencing further liquidations, or are you expected to? So if you think this is a short and you're happy to take a short from here, you know, you might have been short from this candle here at 69.60s. You may have been short from a little bit lower, you know, 69.55s, and you're holding this short. But if you look, you know, we're trading into that mid time frame, higher time frame area, which on the hourly, it looks like it wants to go lower. And the reason I say that, this failed to take out this, which suggests that this is low. So we may want to come down into, you know, negative ATR 50s. Obviously, we're trading around the point of control, which is also the daily open. So there are a number of arguments for us to sell this right now. And whether that will be allowing us just to get short into the US session or not is obviously yet to be seen. But, you know, obviously, if we look at where's the market open. So Wednesday, 3 a.m. through Asia, we've just traded lower. And the open of the European session has been pretty muted. You know, a little bit of volume on the London Open, but not much. So price could look to head lower on the interim. Let's look at the M15 and see what we're grabbing. Again, switch, change, comes back in. I mean, it's so corrective. You know, we've had that rejection off of this. As we come down into the M15, we can see that there are some points of demand that may want to be respected. I just can't tell at the moment. You know, on a higher time frame, I might be bearish down into 6900s. But the overall, this PA is, you know, for me, it's not tradable just yet. Anyway, I don't trade until New York now. And again, last few days, I've not traded as much just because of how busy we are. So we took this, change of character. Yeah, I mean, I think this is going lower. I think it's going lower. This, although we've had this change of character here, this is on a lower time frame. And to me, that looks like realistically that's going to be used as some form of liquidity. So I see I see this going at least into the US session. If we head into the US session and we've seen further right-hand side development, that general overview of the market could change. But for now, I see this market going lower into something so we get long. I don't see it going lower for longer at this moment in time. But I'd be okay if I was to short that maybe into, I don't know, at least into 69.37s. But again, if you're trading a 1-to-1 fixed RR or a 1-to-1.5, then you're going to be looking at that over a specific level. But as long as you can identify where your targets are versus potential structural and technical key levels, then you'll just want to identify, can you get the RR in that trade? Is the RR available? Let's take a look at gold. I need to close some stuff. 1 second. Close that window. I've got multiple terminals running, which causes some delay when you're doing streaming. All right. So yesterday, pretty dull day. If you look, you had a small retracement current market is looking to try and defend that level. So demand is looking to continue higher. I mean, again, since 4,400 on that retests, we've been trading higher, which was the level that we called to buy from. Sorry, I'm just using one hand. I could use two, but Monday. So look, nothing. There was no direction yesterday, right? Look, so we have this. We have lower highs being printed, and we have higher lows. So we're waiting for a breakout on gold. Again, the direction of this move matters, as well as where we are in the move. Okay, so we're at the highs on the 1 hour. We're at the hourly high is about 5,000. So we're sitting around that 5,000 level, you know, between 5,100, which is areas that we ideally want to be looking for longs from, and we're being held by the support at about 5,000. So price is contained inside this wedge. Because we're sitting at the highs, we do need to be considerate that we could be shorting this because we're trading at the highs. But overall, the market is trying to recover from a bearish move. So we're looking to cover bullish. So wait for the break. Can you trade the extremes? Yes. Bear in mind, the lower highs are weak. The higher lows are weak. So both the lows and the highs are weak. Can you trade from the extremes? Yes. So like, for example, you can trade this. Oops, I put the wrong one. You can trade this, and then you could trade, you know, from here. I'm not saying you should. I'm saying you could. Again, on the 1 hour, you're not going to be necessarily hitting that. You're going to be looking on the M5 or the M15 if you're just trying to trade the range. On the so we've had that low higher than this. This high is lower than this. Demand on this front leg is showing some good move, really. Look, higher, higher, low, high, 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 low, high, 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 low, high, 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 low, high, 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 low, high, high, equal low, high, high. Now we're selling off from the extreme. So similar scenario, we've made a higher high, or attempt to make a higher high, and we've rejected. So in theory, we could look to get short on this candle, you know, trading the extreme. Looking to, initially, you're going to look to see if this ascending trend line holds. Your RR isn't necessarily there. It's a negative RR. Again, spot 86 to your RR. If you're looking for your 1, it's slightly below your 1.5. If you're looking to trade to the extreme, there's about 3R available. Again, not saying you should, just saying you could, if you believe that we're going to continue trading inside that range. Alternatively, what you should do, or could do, sorry, is wait for the break. You know, let's wait for the break, and then wait for the market to actually give you the sign that we are trading in that direction. If you're too early, you could get caught in the move because, for example, if it breaks, retests, and you get in, then what you could see is a drift back into the range, which we always discuss. And of course, you could do the exact same on the flip side for your short. So if you were to get in after the retest, you would get in here, you know, market could then just trap you and continue to take higher, which, again, like I said, when you're trading ranges, there are multiple different scenarios once we get a confirmed break. You could break out clean and continue. You could break out, retest, continue clean on either side. You could break out, retest, fade off back into the range, then trade back up. You could break out, retest, fade back, trade down to the downside, break out to the downside, retest, continue, then trade all the way back up. you have to understand your model on a probabilistic basis. And again, the patterns that you identify in the chart are just used for confluences. They're not certainties. They're not exact. You will get them wrong. They will screw you over and they will take you out. And sometimes they'll go in your direction and they'll take you out before they go in their direction. So you have to, your risk management, mental edge, your physical trading edge has to be on point, because the markets aren't going to necessarily move in the right direction or the direction that you want them to in the way you want them to all of the time. So if you understand your risk to reward ratio, then you've got all of your risk metrics, you understand how to read the markets, and you are trying to day trade, then of course you have to understand that you are going to get stopped out 40% of the time, 30% of the time, 60% of the time, 50% of the time, whatever your risk to reward ratios is/are. So gold for me, if I'm trading the range, then I'm short right now because I'm shorting the extreme. I'll be looking initially to target your 1-to-1, your 1-to-1.5, but overall target will be the extreme of the range, which is the ascending trend line of the wedge. I do have to factor in that ascending trend line, which is in the middle of that move, which is currently acting as your ascending trend line support. But for now, you know, if I was to be in this, again, because I'm trading from the extremes, from the descending trend line resistance, then I'm short, at least into 1-to-1, with the caveat being when this level gets hit, I'd have an alert on it, for example, and it would say price is trading into the trend line. From there, I have a call to make, and that's where your discretion and your intuition comes in play, and you can't really teach that. Silver will be doing pretty much the same thing, so you know, we can take a look at that. Again, significant pushes to the upside. Yesterday's candle was a bit nicer in silver. It was actually a bullish move, really clean. There is some imbalance inside all of these, so obviously there's a lot of volume to be traded. We've broke this high. We're coming into 85s. That 85 level could potentially pose as an area of resistance or supply. It might be this whole range, for example. That's on the 4-hour, right? Yeah, look, so we've got a breakdown low, lower high, lower low. We're now coming into this area of resistance. So this could poise a potential opportunity to wait for shorts. So let's wait and see on that. As for the move into that, you know, demand's been respected. So we've got, okay, so price here is just coming to the imbalance, which is this. We've then got this whole range here, which has been respected. Initial mitigation, traded up, failed to take out this. What then happened? This was all used as liquidity to come into the extreme, which was respected. So price swept. We failed to break higher. This was all weak. We've traded lower. We've taken out the weak lows. And then we've started to build on the momentum from the previous move. So demand is in control at this moment in time. No way I'm looking to short anything at this moment. I'd be waiting for price to come into 85.50s or start to come off. And then obviously I'd be looking for continuations from there. So again, nothing done in silver. Let's take a look at the DXY. Does anyone have any questions, comments that they'd care to make? Just again, we're getting into the near the end of the session. Again, if you aren't trading with Seacrest Markets, you know, open and register account up to 1-to-500 dynamic leverage, multiple instruments to trade across all of your favorites, your majors, your metals, your indices. Spreads are extremely competitive. And as you can see, as per the banner on the live stream, you can trade multiple instruments up to 1-to-500 leverage. And of course, there is a credit deposit bonus for your FTD. Obviously, please read the terms and conditions. Again, from a trading perspective and our live streams, this is purely for educational purposes only. This is not a signals chat. This isn't supported as advice or intended to constitute any form of financial advice. I don't predict what's going to happen in terms of NFP and what's going to happen to a particular currency. It all depends on the data, what's going to happen. So as I mentioned earlier, from a day trading perspective, we look at the consensus and the analyst expectations and the previous readings. We also need to look at the previous reading to understand on that previous data that was reported, has it been revised? For example, if it was 70,000, has that been revised up to 80,000 or has it been revised down? The S&P as a whole, like if we look at Euro, it's bullish at the moment. There is strong short-term momentum, which is targeting 120. The S&P, which obviously we covered earlier as well, it's got to hold that 6,900 with 7,100 being the upside cap until clarity from NFP. What we need is NFP clarity. When we get the NFP clarity, we can look to fade it and we can look to trade. Until that point, I'm quite happy to sit on my hands and maintain cash so that my gunpowder remains dry so that I could take advantage later. Worst thing you could do is trade into NFP and get stopped out and get margin called and lose your personal account, or lose a significant amount of capital because you got slipped, or lose a prop account because you've hit their daily drawdown if it's a hard breach or a maximum drawdown again. You don't want to do that. So DXY, I mean, lower high has been printed. So the expectation at this moment is for this low to go. If I look at yesterday's candle, obviously, you know, attempted to break lower but contained. Today's candle is attempting to do the same thing. This could end. This could change by the end of the day. It could be completely reversed. But at this moment in time, we're heading towards that week low at 95.5. I'm comfortable to continue maintaining that position or that idea at this moment. If non-farm payrolls comes out to support the dollar, then of course we could see this candle right now respect that low, start to build off of that momentum and actually start to see demand take control, which will mean inherently that supply will be failing and we'll start to trade higher into that 100 handle. But that's pretty much it. I know I started a little bit late due to technicals. There aren't many questions coming in, and I've answered all the questions that are resting. I've covered most of the instruments that you wish me to cover. From a risk perspective, it looks like we're happy to continue trading into safe havens such as metals at this moment in time. The S&P will, the S&P looked like it was primed for a pullback. Then again, so did gold based on the range that we were trading in. I'll double check that quickly, see what's happened since we last spoke about it. Similar for silver, obviously the momentum is to the upside. So the expectation is uncertainty in the economy at this moment, but it looks like it wants to pull back into the discount for us to get a better level to trade off of. Look, gold is just hovering around those resistance areas. So tried to sell off, respected this demand, and it's just trying to edge higher. So, you're trading off of that extreme. At the moment, you'd be underwater because your stop would be slightly higher, but your entry point would have been around here. So you're slightly offside at the moment. But if you're looking to trade that wedge, because you're trading from extreme to extreme, if you're trading against momentum, overall momentum, obviously you're going to have to factor that into your probabilities. But market looks like it's resting ahead of NFP. So wait until NFP comes out. Then from there, try to see what the cards are showing you from a market perspective, and then look to take a trade. But until then, until NFP, I'll be sitting on my hands. Obviously, if you've got any questions, please feel free to reach out to me on Twitter, or hold your questions until tomorrow's stream. If anything happens during today's trading session, please make sure to write those questions down if you want me to cover them during tomorrow's live stream. Other than that, I'll see you tomorrow. I'm here Monday through Friday, every single day, hosted by myself, breaking down the markets fundamentally, technically, analytically, however you want me to do so. But again, as of today, please be aware of the news. And around that news, trade safe, trade smart, trade Seacrest, and I'll see you same time tomorrow. Thank you all for attending, and I'll see you tomorrow.
Patterns emerging, psychology's key. Discipline strong, no greed in the spree. Risk managed tight, emotions in check. Seacrest